Does analyzing a company feel like trying to read alien language? Stop right there. Today, I'll break it down into super simple steps. You'll go from what even is EBITDA to I've got this in no time. Trust me, your financial smarts are about to level up. Step 1. Start with gross profit ratio. All right? First, check the gross profit ratio. It's just the money left after covering the cost of making products. If it's high, the company has room to handle other expenses like marketing or paying its employees. But if this ratio is low, that's a red flag. Why? Because the company's barely making enough to stay afloat. Step 2. EBITDA margin. The real business health check. EBITDA margin. Fancy word, right? It's earnings before interest, taxes, depreciation, and amortization. Phew, what does it mean? It tells you how good the company is at running its business. Higher is better. Lower? Well, trouble's lurking. Step 3. PAT margin. Profit after all bills. Now, let's see what's left after the company pays everyone. Taxes, loans, the workers. That's the PAT margin, profit after tax. If there's not much left, it's like working overtime and taking home pennies. Not cool. Step 4. Growth is king. EPS and sales growth. Now, let's talk about growth. First, check EPS, earnings per share. Is it growing year after year? That's awesome. Next, look at sales growth. If the company's selling more, it's doing something right. But wait, don't stop there. Step 5. Compare growth with industry. Here's a ninja trick. Compare your company's growth with the industry's. Imagine this. Your company's top-line growth is 20%, but the industry is growing at 15%. Boom! Your company's gaining market share. That's what you want. But if the industry's growing at 25% and you're stuck at 20%, guess what? Others are eating your lunch. Step 6. PE ratio and ROE. Are you paying too much? Now let's talk about price. First, check the PE ratio, price to earnings. Is it too high? You might be overpaying. Too low? There could be hidden problems. Next, find the ROE, return on equity. It's simple. Divide EPS by the book value. Done. Step 7. Match ROE with growth. Here's where things get juicy. If ROE is equal to growth, like 20% growth and 20% ROE, that's perfect. But if growth is 20% and ROE is 15%, uh-oh. The company might need a loan to grow. Now, if growth is 20% and ROE is 30%, jackpot. That extra 10% could mean dividends for you. Step 8. Decompose ROE, but don't stop there. Decompose ROE into 3 parts: net profit margin, asset turnover, and leverage ratio. It's like peeling an onion. What's really driving that ROE? Is it profits, smart use of assets, or too much borrowing? Step 9. Cash flow, the lifeblood. Finally, check the cash flow. Without cash, even the best-looking companies crumble. Don't know how? No worries. Here's a hack. If ROE is above 30%, chances are cash flow is positive. But if growth is stuck at 5%, run for the hills. Final takeaway. So, remember, start with gross profit. Check EBITDA and PAT. Dig into growth, compare with the industry, and never skip ROE or cash flow. It's like building a puzzle. Every piece matters. Now you're ready to analyze any company like a pro.